All right, let's talk about something that drives almost every trader crazy, the sideways choppy market. You know the one. We're going to break down how you can stop fighting these conditions and actually start winning in them.
So get this, because this one statistic really changes the whole game. It turns out that markets are only in a nice, clear trend about 30% of the time. So what about the other 70%? Well, they're stuck, just chopping back and forth in a range. That means the condition most traders hate is actually the market's normal state.
And that's the big question, isn't it? If the market is going sideways most of the time, trying to wait for a perfect trend means you're just sitting on your hands. The real secret, the real edge, is learning how to play the game when the market's going nowhere fast.
Okay, so to get good at this, we first have to really understand why these markets are such a minefield. Let's dig into why so many traders get stuck here.
You can almost think of the market as having two personalities. You've got the trending market, that's the one we all love, right? The price is moving in a clean direction, things make sense, it's predictable. And then you've got the ranging market. It's erratic, it feels random, and it's just plain hard to predict.
And here's the trap that gets everyone. Most of the popular trading tools we learn to use, things like the MACD, they were built for those nice, clean trends. The moment you drop them into a choppy, ranging market, they start going haywire. They just spit out one false signal after another, which just leads to confusion and a whole lot of losing trades.
So, if our usual indicators are going to lie to us, we need a different approach. And that brings us to level 1. Before you can even think about trading a range, you have to get really good at spotting it. This is the absolute foundation for everything else we're going to talk about. The key here is something called market structure. Now, I know it sounds a little technical, but it's really simple. It's just about reading the story that the price's peaks and valleys are telling you. In a healthy uptrend, the price makes higher highs and higher lows. It's like it's walking up a staircase. A downtrend is just the opposite, walking down the stairs. So how do you see the change coming? You watch for a break in that staircase pattern. Let's say we're in a nice uptrend. Suddenly, the price tries to make a new peak, but it fails. It can't get above the last one. That's your first major warning sign. Then, if it tries again and fails a second time, that's your confirmation. The upward energy is gone. The market has officially shifted from trending to ranging. All right, so now you can spot a range. Awesome. Now let's actually trade it. Welcome to level 2, the bounce. This is the classic bread and butter strategy for sideways markets.
To use this strategy, you first have to define your playing field. Just think of the range as a room. The price is like a ball bouncing around inside it. The top of that room, the price ceiling that it keeps hitting its head on, we call that resistance. The bottom of the room, the floor that it keeps bouncing off of, we call that support.
Now, the whole idea here is beautifully simple. You'll start to see this pattern over and over. When the price comes down and hits the floor or support, it tends to bounce back up. And when it goes up and hits the ceiling or resistance, it tends to fall back down. The entire strategy is just trading those predictable bounces between the floor and the ceiling.
But, and this is a really big but, the market is almost never perfect. The price isn't always going to perfectly touch the very top or the very bottom. Sometimes it'll reverse somewhere in the middle, creating new, smaller levels inside the bigger range. So the lesson here is you've got to be adaptable. You have to watch where the price is actually turning around, not just where you wish it would.
Okay, but what happens when that room is too small to really bounce around in? Well, that brings us to level 3, a totally different strategy for a very specific situation, the breakout play.
So a narrow ranging market is exactly what it sounds like. The floor and the ceiling are super close together. There's just not enough space to make any real money from the bounces. When you see this, it's a huge sign of consolidation. You should picture it like a coiled spring, just getting tighter and tighter, building up energy for a massive, explosive move. Our job is to catch that explosion.
Now, trading breakouts is really tricky because of something called the false alarm or the false breakout. You'll see this all the time. A tiny little candle just barely pokes its head above the ceiling. It looks like, this is it, it's starting. But it's usually a trap. It's designed to suck you into the trade right before the price slams back down into the range.
So we have to be patient and wait for the real signal. And this shows the difference perfectly. We're looking for commitment. A real breakout isn't shy, it's confirmed by a big, powerful momentum candle that just completely smashes through the level. That strength, that power, that's our signal that the breakout is for real. And now, it's go time.
So we've covered two really powerful manual strategies. But let's be real, in a market that's choppy 70% of the time, trying to do it all by hand can be exhausting. That's where automation becomes a total game changer. And it brings us to our final level, the grid bot.
So what the heck is a grid bot? Well, it's a tool made specifically for these annoying ranging markets. What it does is it places a whole grid of buy orders below the price and a grid of sell orders above the price. As the price wiggles down, it automatically buys a little. As the price wiggles back up, it automatically sells what it just bought for a small profit. And it just does this over and over and over again 24/7.
Now listen up, because this part is super important. These bots are not a magic bullet you can use everywhere. They shine in sideways, ranging markets. They can also do pretty well in weak uptrends that have a lot of pullbacks. But, and I mean this, you absolutely want to avoid them in strong downtrends or powerful uptrends. In those conditions, they can really struggle.
And the cool part is, setting one up is surprisingly simple. You just use those skills we learned in level 1 to find something stuck in a range. Then you tell the bot, hey, here's the resistance, that's your upper price, and here's the support, that's your lower price. You pick how many grid lines you want, decide on your investment, and you just let it do its thing.
So let's just wrap up this awesome toolkit we've put together. For those nice, wide ranges, you've got the bounce strategy. For those tight, coiling ranges, you've got the breakout play. Just wait for that big momentum candle. And for a hands-off approach to just grind out profits from all the chop, you've got the automated grid bot.
And that brings us right back to where we started. That 70% number, it's not a problem anymore, is it? It's an opportunity. You now have a set of strategies specifically designed for the market's most common personality. So the only question left is, are you ready for it?